My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. Hope you want to make friends. I'm just trying to help you make a little money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. So, tech has a pulse. No, a real pulse after all. Yeah. Tech's been the weak spot of this market for ages. Today, the Dow tumbled 392 points, the S&P declined 0.21%, and the Nasdaq actually rallied 0.14%. Now, that was the seventh positive day in a row, but this time it was actually led by some stocks that have been hurting it. The beleaguered software and semiconductor stocks. They're making a comeback, at least today. Now, people have been flocking to the mighty Dow, bent on going with the bluest of blue chips, while abandoning anything that seemed expensive, including most of tech. Today, though, it sure looked like tech's finally gotten cheap enough to survive even the toughest downgrades. But make no mistake, this is a counter-trend rally. The companies that have reported so far, chiefly the large banks, have been superb, even as it was overshadowed today by the disappointment from Goldman Sachs. It was a bizarre and, frankly, hopefully aberrant conference call filled with distractions. Frankly, I think Morgan Stanley up nearly 6% is a bigger deal than Goldman down 6%, if only because it finally dawned on people that Morgan Stanley is becoming a repository of wealth management, not just a firm hostage to trading or underwriting. Morgan Stanley isn't leading the pack of banks, it's leaving the pack behind, which is why it's not getting a higher price-to-earnings multiples or reward for its more consistent business, but ultimately will. More on that later. What really matters today is that the decline in the Dow masked a robust session for some of the more forlorn parts of the Nasdaq. And that strength deserves an explanation, because I know that some of you who have been losing money will be very gratified by what happened today. First, as I mentioned, if you punish a group daily for being too expensive, eventually it's going to get cheap. Take Apple. Now, here's a stock that now sells for a paltry 22 times earnings. I regard it as paltry because it's such a great company. Apple's the premier technology enterprise of our time, unrivaled brand. Yet its stock sells much cheaper than Clorox or Church & Dwight or Colgate-Palmolive, all of which sell for anywhere from 25 to 36 times earnings. I'm always comparing Apple to these companies because they're big, consistent consumer brands, but Apple's so much more than that. It's a classic technology innovator. It should trade at a premium, not a discount. But now it's gotten cheap after the stock's fallen from 182 to 135. Now throw in some incredibly bullish research that we heard today, which suggests that Apple might give us a strong forecast when it reports, and then you can understand why you got a nice rally. Now, I know Apple isn't technically a consumer products company. It's a tech leader. But how the heck did it get cheaper than bleach? Now, I am less sanguine about this forecast issue. I doubt Apple will give us strong guidance, aside from the weakened dollar. I don't want anyone buying this stock on anything other than the lifetime value of its customer base, which is far in excess of the kind of customer loyalty you see for, say, a water pick or a Colgate toothbrush. Both worthy pieces of technology in their own right, although they don't hold a candle to the iPhone. As always, I say own Apple, don't trade it. But its strength today reminds us that stocks do get cheaper when they go down. And you know what? Tesla's in the same boat. Tesla! Look, here's a company that's been forced to slash prices almost as fast as its stock has been slashed. It's come down so low that Tesla stock was selling for 20 times earnings estimates at the close of January 3rd. That rally today, up $9, is significant because it comes on the heels of 4 price target cuts and a severe estimate cut by a respected analyst. Yet the stock roared today. Again, I think that's a function of Tesla being not an expensive car company, but a cheap tech company. Oh, then there's the real conundrum, which is Microsoft. Now, we sold some for the charitable trust last week, something we discussed several times for the edification of club members. And we did it because management didn't seem to have a sense of urgency when it comes to cutting overhead, even as their own customers are pulling back. The stock got downgraded today to a sell. Sell. By one firm today. I was shocked. It's odd given the company's consistency. I worried it might be some kind of coup de grace for the bulls. Instead, it was a clarion call that Microsoft might be too cheap. down here at 25 times earnings. Hey, listen, it was at 35 times earnings not that long ago. Stocks, again, of high-quality companies do get cheaper when they go down. Not low-quality companies, but high-quality companies. Really, Microsoft was boosted by a leak also that they might be planning big layoffs, a formula for success in tech, because it tells you management recognizes the new reality is a lot more cyclical and they want to get their earnings more in line with their revenues. There's urgency, and why not? It worked for Meta Platforms, formerly Facebook, and it worked for Salesforce, at least so far. Why not Microsoft? Any good news on this front is buttressed by the seeming inability of Alphabet or Amazon to get with the darn program. We're all waiting for something to happen from these silent mega caps. Feels like waiting for Godot. Amazon stock fell more than $2 today. Google lost 83 cents. They are lost in the high-expense ether until they tell us otherwise. Of course, there's been nothing but free fall for the enterprise software and cybersecurity stocks this year, so it's nice to see them get some occasional lift. But other than Palo Alto Networks, I'm not seeing the slimming down or pivoting to profitability that might give these recent moves staying power. Oh, and did anyone notice that NVIDIA stock may actually be bottoming? I saw a cup and handle there. That's a technical positive that only chartists care about. These days, everyone's a closet chartist when it comes to the hideous action in tech. AMD lifted too. The big difference is that AMD sells at 20 times earnings, not more than 40 times earnings like NVIDIA. Then again, if there's a thaw in relations between U.S. and China, a lot of whispers out of that from Davos, then NVIDIA would be the semiconductor stock that might see the biggest pop. It suffered mightily when our government put the wood to China. Maybe it can recover. An 8-point rally, almost 5% today, sure helps get it there. Now, look, I know it wasn't just Goldman that brought down the Dow and the S&P today. We saw some heavy selling in companies that need a strong economy, possibly suggesting that the recent run in the cyclicals might be over. I heard that all day. Given that we got yet another weaker macro number today. I'm talking about the New York Fed's Empire State Manufacturing Index, which is very, very weak. I think it's the pause that refreshes, though, and I remain more partial to those traditional cyclical stocks. You're getting a chance to buy them ahead of what I believe will be better earnings comparisons than you're going to see from tech. The same way you got those better comparisons that shock people from the financials on Friday. It is so easy to panic out of stocks on the first sign of weakness. Because you read a lot of headlines that says, oh, boy, market too far, too fast. It looks, what's the big sell-off about? Especially when you have the come-hither two-year Treasury at 4.2%. I'm urging the opposite, though. I see a minor core counter-trend rally that might cause the downgrading analysts to wonder if they are too negative, and the sideline analysts ready to turn positive now that buyers have so-called found a level to buy tech. To me, that's a natural expression of support for a part of the market that's playing catch-up, the part being the beaten-down tech sector. Bottom line, I say let tech run for now, but remember, when we get to earnings starting next week for tech, the advances you see now could wipe away the cheapness factor. And if you own or insist on owning tech here, you want to be in the ones that are cheaper than the consumer product companies that make pet food or cookies or soft drinks, for that matter. Let's go to Joe in California. Joe.
Booyah, Jim, from Huntington Beach.
Now, what's going on, my friend?
Hey, Jim. So my question is about Chevron. With Chevron having that special ability to operate in Venezuela, as well as them having a huge market share in California, are they the oil company to be looking at right now with this oil forecasting to grow above $1.30 a barrel?
Of the giant oil companies, they are. Mike Wirth was on Squawk Box this morning, and he was magnificent, the CEO. Nice move today in the stock. I got to tell you, Joe, you got a good one with Chevron, buying back a lot of stock, and all those things you said are certainly playing into their hands. It's been a winner. I think it stays a winner. All right. I say let tech run for now. But remember, you want to be in the ones that are cheaper than the consumer product companies. They're better, too. On Money Tonight, as we approach the 3-year anniversary of the COVID-19 outbreak, what companies are beneficiaries to continue reopening trends? I got some good names. I'm on a bunch of them. Then it was a tale of two financials, Goldman Sachs and Morgan Stanley. And I'm breaking down exactly what I saw in the reports handed in earlier today. And Darling Ingredients is in the business of converting animal byproducts to fuel. So could the stock be an under-the-radar way to energize your portfolio and decarbonize it? I'm checking in with the CEO, so stay with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.